What's up, everyone? It's Caddy with MoneyVest. So thank you so much for joining in for our live stream. And today is the day. We've got the FOMC meeting in less than an hour. Right now, it's about 1:30 p.m. Eastern over in New York, over in the US. And in less than 1 hour, we've got Jerome Powell coming on board with the speech. And what color is the tie? Kevin is asking. We're going to do a poll for that as well, Kevin. But thank you so much for joining. We've got the statement and the the SEP, the Summary of Economic Projections, which is also going to be released in less than 30 minutes. We're going to break everything down. As always, make sure that you drop a like and, of course, subscribe to the channel. And the one thing that I want you guys to do that I would really appreciate if you could is share this live stream. Share this live stream with people who might be interested in joining us today. All you have to do is basically come over here on the live stream itself. You see that share button right there. You can hit share. You can copy that link, share it on WhatsApp, Facebook, Twitter, Reddit, Instagram, wherever you want to share this. Definitely please do that. I would really appreciate that so that more and more people can join us and, of course, be a part of our MoneyVest community. We can get a lot more data points and, of course, get some more answers on the poll. Right now, we've got close to about 100 votes. So this right here is the poll that we have going on right now. And we've got about 197 votes right now. What you think is Jerome Powell going to do? Is he going to be hawkish, dovish? Let us know. It's 66% people right now voting for a hawkish Jerome Powell. So definitely do vote. We're trying to get to at least 400 or 500 votes in the next hour before the FOMC press conference begins. So definitely do share this live stream. Again, you can simply just share, create a post, or copy this link. I would really appreciate that. And of course, drop a like and subscribe to the channel as well. So we've got lots to discuss, lots to break down before the numbers are coming out here. Also, do check out the links down below for our Patreon and for our Discord. And of course, let's just dive right into the markets right now. S&P 500 is slightly up, or basically flat, about as flat as it can be. Just no change, 46.45 right now. We've got the NASDAQ still up about 9 basis points. IXIC is a little bit down 7 basis points because Magnificent 7 is somewhat down to slightly flat. We are seeing some stocks push higher. Some of them are going down. So Netflix, Apple pushing up a little bit, 2 to 1%. And Tesla here definitely selling off. AMD starting to pull back. Google, Amazon, Microsoft, and Meta also slightly lower on the day, with the Dow Jones here basically flat. And of course, the 10-year yields are slightly down about 80, 90 basis points as well. So, so we've got the poll going on. Volatility is up 3%, Mano says. So yes, the VIX is up over 3%, but still very, very muted and very low at 12.46. In fact, we're hitting our lowest levels in over 3 years. So that again is a really, really low volatility number, and something that we are keeping in mind because it is going to be incredibly important for us to keep a close eye on. Hold on 1 second, everyone. Just give me 1 second. All right, everyone, I do apologize. Just give me a check on audio video. Just want to make sure the audio and the video is good. Just give me a thumbs up. I just want to make sure that everything is working well. I don't want to disturb people here because there are people that are sleeping in my home. Anyways, so going back over to what we were talking about. So this right here is going to be the rate decision plus the guidance for 2024, right, in terms of expectations from the Summary of Economic Projections. So we already know that there is over a 98% probability that the Federal Reserve is going to keep interest rates where they are, right? So they're not going to hike interest rates. They're going to pause them with over a 98%. Caddy's mom brought him some sandwiches because this is going to be a long live stream. No sandwiches, but she did come into the room because I was a little too loud. So I'm going to try my best to lower my volume So hopefully we can continue because this is going to be a longer live stream. It is pretty late here. It's past midnight, and this live stream is probably going to go until 2 in the morning. So so I would really appreciate it if you drop a like. It would mean the world to me. Now, when it comes to the guidance for 2024, this is where things will get interesting. This is really what matters for the market. And that is because the market doesn't really care about what's already happened, right? We've already seen over 500 plus basis points of hikes from the Federal Reserve in the last 12 months, 12 to 18 months. But what really matters is what's going to happen in 2024. And this right here are some of the expectations from me. Because if you go back to what the summary of economic projections looks like from their September meeting, so this right here again is the Federal Reserve .gov. You can go to this website and you can check out all these statements and these press conferences and the summary of economic projections for yourself. So if you go to the September meeting and we go to this projection materials and you come down, what we witnessed was that going into 2024, we basically are seeing rates go down from 5.6 to 5.1%, right? So that's a 50 basis point cut. In other words, 2 cuts of 25 basis points each, or 0.5%, is how much we're going down. And this is really where the market's going to be focusing on. There's 2 things that the market's going to be very interested to know from the Federal Reserve. And that is the interest rate decision from today, which there's over a 98% probability that they're going to pause. So we're not going to actually see a rate hike, right? So 98%, we're going to stay steady where we are. And then of course, 5 cuts priced into the market going to next year. So that's number 1, is the rate decision from today. And the second thing is going to be the 2024 guidance, which is going to be in the summary of economic projections. Now, let me ask you this, and I want more engagement in the comments, in the live chat. Between the 4 things, economic growth, which is GDP, unemployment, inflation, and interest rates, why does the market care more about interest rates as opposed to the other 3, which is unemployment, inflation, and GDP, right? Because the Federal Reserve in their SEP also is forecasting for GDP, for unemployment, for inflation. They're also putting together their estimates for those numbers right here, as you can see, but the market doesn't care a lot about these numbers, right? The market doesn't care about what they put down here, but the market cares more, a lot more, about what they put down here for interest rates. Why is that? I want to hear from all of you, so comment in the live chat why you believe or why you think the market is going to put more weight. It cares a lot more what the Federal Reserve is going to do with interest rates as opposed to what they put down for inflation, economic growth, or unemployment. So let me see who's been doing their homework and who's been following up with the videos and with the macro. So Mano says because interest rates are the main variable for the discounted cash flow models. So that is true. That is very true. And that is correct, but that's not the exact answer that I'm looking for. Sanjeev says because it has a ripple effect on everything. Also very true. So that is also the starting point. But why is it that the market more specifically focuses on the Federal Reserve's? I guess what I'm asking is when we look at these summary of economic projections, why is it that these numbers up here don't mean as much as the numbers they put down over here? Low interest rates translates into higher corporate profits, Richard says. So again, these are all correct answers in their own way. But why is it that the up there, the numbers that they put down don't matter at all versus what they put down over here? So because interest rates make investment into bonds more lucrative. Archie says yields, it has effects on both micro and macroeconomics. It affects all 3 aspects above. It's more forward looking. So let me ask you one more question in a different way. Of the 4 things that I mentioned, GDP, unemployment, interest rates, and inflation, what is the one thing, what are some things the Federal Reserve has full control over, and what are things the Federal Reserve has no control over? What would you say the Federal Reserve has full 100% control over in those 4 things, the GDP, unemployment, inflation, and interest rates? Between those 4 things, what does the Federal Reserve control fully, and what do they not control? So Cindy says because you can change it easily. Yes, so we're getting closer. I'm going to wait for a few more minutes until more answers come in into the live chat. But the reason why the market's very much going to be focused on, and that's really why the market's going to be looking into what the Federal Reserve puts down here, is because of their ability to control interest rates 100%. They set the tone, right? They set the interest rates. Everything else is a prediction. Everything else is an expectation. You ask anyone today, what do you think the unemployment rate will be 12 months from now? They have no idea. You ask anyone today what inflation will be like 12 months from now. They have no idea. There's nobody in the world that can make a prediction for where interest rates, GDP, and unemployment will be 12 months from now, let alone 24 or 60 months from now. But the one thing the Federal Reserve can control very well is interest rates. The level of interest rates they have full control over. It's not an expectation, it's not a prediction, it's what they're putting down where interest rates will be 6 months or 12 months from now. That's the reason why the market's main focus is over here. Whatever they put up here doesn't really matter because they could be wrong. They will be changing their predictions. They will be changing their expectations. But this right here, interest rates, is what really matters to the market. And right now we know that there is a discrepancy between what the market's pricing in versus what the Federal Reserve's penciled in. The market's pricing in 5 cuts, right? And the Federal Reserve's priced in 2 cuts. And that was also after one more rate hike in 2023, which chances are is not going to happen. 98% probability the Federal Reserve is going to pause today. So 65% hawkish right now. Please definitely do vote. We've got 175 votes right now. We're trying to get to at least over 300, 400, 500 votes prior to the actual press conference. So definitely do participate in the poll. But that's where we are with the summary of economic projections. Just wanted to run this number down. Very, very closely, 5.6 to 5.1% is where we are. The bond market right now, the short end of the curve, still yielding well over 5%. So anything that's over 1% over here, you'll notice is sitting at well over 5.1, 5.3, 5.4, 5.4, 5.4. So these are all well over 5%. And when you look at the S&P 500's valuation, by the way, all these are going to be available. This type of analysis is available with our Patreon and our Discord. So link's going to be down below if you want to join. 4.85% is the current earnings yield on the S&P 500. So that's where we are with the S&P 500's current earnings yield, which is a reciprocal of the price to earnings multiple. And price to earnings right now, of course, sitting at well over 21 actually, since we have rallied over 46.40 now. So that's the level of the index, S&P 500 46.43, and the current price to earnings multiple is now sitting at well over 21, which again, if you take the reciprocal of that, we're sitting at just under 5%. So the short end of the curve, which is the bond market, anything that's less than 1 year maturing, is yielding way above, well above 5%, which is more than the S&P 500's earnings multiple. Okay, so everyone, let's see. Thank you so much for joining. And again, very, very good answers here. They control interest rates. Federal Reserve wants the neutral rate to be steady between 2.5 and 3%. So if the inflation is more than the expected, the neutral rate decreases. Now, I was having a very interesting discussion with my uncle today as well. And we were talking about if and when the Federal Reserve will start cutting interest rates next year. And we basically came to a conclusion that they will need a reason, right? I basically asked him a question, what if next year inflation's at 2.5%, okay? And unemployment still is at really, really low levels. Let's say that unemployment's at 3.5%, right? Really low. Economic growth is still strong. Annualized basis, GDP is growing at 2 to 3%, and inflation's at 2.5%. Then what? Does the Federal Reserve cut rates, or do they keep them higher for longer in hopes of bringing inflation back down to under 2%? What do you think? What do you think is the Federal Reserve's response to an environment where inflation's above the target at 2.5% and the economy continues to be very strong with unemployment at 3.5 and GDP continues to grow on an annualized basis? What does the Federal Reserve do then? In my opinion, if the economy is strong and continues to handle such high levels of interest rates and inflation still above the Fed's target, that's going to decrease the probability of potentially cutting rates, in my opinion. The market's pricing in 5. They may not do 5, they may do 3 or maybe 2, or may not even do any rate cuts if the economy continues to be super strong, unemployment's low, and inflation's still above the Fed's target. It's just my 2 cents, right? If I were in his shoes, if I was in Jerome Powell's shoes, if I were the chairman of the Fed, I will look at the economy and I would be like, okay, economy is super strong. People are still spending money despite the higher interest rates. Unemployment is really low, and inflation is still above the target of 2.5%, 3%. Why cut interest rates? Because the biggest problem with cutting interest rates is what? It stimulates the economy. It is a way of quantitative easing. And every time the Federal Reserve pivots, whether it's from quantitative easing to tightening or tightening to easing, every time they pivot, they do it with purpose. They do it because they need to fix something. You go back, you literally study monetary policy, and every time the Federal Reserve has pivoted to cutting rates or raising interest rates, they've done it to fix something. They've done it because they needed to fix something. They cut rates to stimulate the economy, to bring us out of recession. They tighten rates because they want to bring us out of very high levels of inflation. They do it because there's an incentive of pivoting. And if that incentive is not there, I find it very difficult to believe that they're going to simply cut rates for the sake of cutting rates. So Jerome Powell is going to be talking in less than 45 minutes at 2:30 p.m. Eastern. But before that, we're going to have the summary of economic projections, which comes out in 13 minutes. So we'll have those numbers live and ready for us. We're going to go over to monetary policy, meetings and calendars. And right here at 2 p.m. Eastern, we're going to have both the statement and the projection materials. We're going to take a look at those. And then, of course, we'll take a look at the market's reaction to the statement and the press conference, the projection materials. And then 30 minutes later, we'll listen to Jerome Powell for 45 minutes. We've got a Q&A session, and then we'll do our analysis and final conclusions before we end the live stream. So it's going to be a longer one, but I want to break down everything so that we're all on the same page. Right now, interest rates are 5.25 to 5.5%. Very high probability the Federal Reserve is not going to raise rates anymore. We're going to be steady at where we are, and interest rates cuts beginning in May. Now, I do expect Jerome Powell to once again sound hawkish because inflation's still elevated. Core inflation, in fact, we got core inflation yesterday. We're still well above 4% right now. And PPI numbers came out this morning. And I think PPI came in a little bit hotter than what the expectations were. So if you go over to PPI final demand, you'll notice that we came in at 0.9%. So that was a little bit softer than the consensus of 1%. Ex food and energy, so core inflation month over month, no change. Consensus was 0.2, and year over year, we're sitting now at 2% when the consensus was 2.2. So it's actually much better numbers on a PPI, producer price basis. Producer price index is basically wholesale, raw materials, manufacturers, and what they pay for input prices. And CPI, of course, is the consumer price index, which takes into account the final goods and services that consumers pay, right? That's why it's called the consumer price index. And this came in line with expectations for the most part. The only hotter print was on the CPI month over month, the headline number month over month at 0.1%, which came in a little bit higher than the consensus of 0.0%. So let's see, folks, we've got over 300 people watching right now. I would really appreciate it if you drop a like, subscribe to the channel, and also do me a favor and share this live stream. All you have to do is just simply come over here, hit share, copy this link, or share it on WhatsApp, Facebook, Instagram, Twitter, wherever you want. I would really appreciate it if more and more people could join us and take a look at the summary of economic projections, the Federal Reserve's press conference here, which will start very, very soon. And of course, the statement that's going to be released from the Federal Reserve as well. We're going to quickly look at the statement at 2 p.m. And the first thing we're going to look at is where the target range is going to be, 5.25% and 5.5%. So that right there, of course, is going to be the target range of the federal funds rate, which they are going to obviously make a decision on. So that's the first thing we're going to look at, and then we'll jump over to the summary of economic projections and take a look at the dot plot, which is going to be over here. How many members in the FOMC are expecting rate hikes, rate cuts? What is going to be that terminal rate over the longer run? And of course, we'll take a look at the dual mandate bullseye from the Federal Reserve. Right now, we're all the way up here, and the goal is for the Federal Reserve to bring this number back down in equilibrium at 2% inflation, core inflation, and a little over 4% in unemployment as well. So that's where we are. At NASDAQ here, about as flat as it can be going into the FOMC. S&P 500 also very, very flat, so stocks are not really moving all that much. We've got a very, very flat market on our hands. and the yields are just over 4.1.5% at the moment, slightly down about 88 basis points at the moment. So I'm going to read some comments now. Again, if you have any questions, feel free to ask about macroeconomics, recession, inflation, whatever it is. I'm happy to help. And definitely do drop a like. We're at 97 likes right now. I'm sure we can get to at least over 200 likes, and also do participate in our poll. And if you believe the Federal Reserve is going to, Jerome Powell is going to be hawkish or dovish. This right here is our poll right now, 234 votes, and we're trying to get to at least 500 before the speech begins, okay? So definitely do participate and let us know what you think. Is Jerome Powell going to be hawkish or dovish in his speech today? And of course, we'll take a look at the market's reaction live. Okay, the point is that we have to think about the technology variable, which gives higher output to the economy, even if interest rates are higher. So yes, that's a good point. And this is something that we also discussed in the research report from Jim Grant, which he talks about that yes, technology can be deflationary in nature. And with respect to artificial intelligence, there's going to be high levels of productivity, which obviously could lead to higher output, right? Economic growth can be very strong. But I also believe that with respect to artificial intelligence, with AI, there could be a new shift, new paradigm in the economy where both unemployment and output is high. We've never had that before. And the reason for that is because you need people to actually produce goods and services, right? People, as in humans, need to work. And if people work, that means higher output. Higher output as in more growth, higher GDP. But if artificial intelligence and robotics and technology takes over to a point where we're seeing a lot of output on the back of high levels of technology and technological advancements in AI, and people are not able to upgrade those skills and they're kind of lagging behind, unemployment could go up and output continues to go up because it's mostly the highly skilled professionals as well as artificial intelligence and robotics that are doing majority of the work, and output continues to go up while unemployment also continues to go up. So it could be a very interesting shift in the overall economy where, I've got an inner bet with myself that there could be a time in the future where in the economy, we're still growing at a very fast rate, and the new unemployment rate, the new normal unemployment rate is well over 10, maybe 12%, because everyone needs to kind of upgrade their skills and be more technologically savvy with respect to AI and all the skills that we need to upgrade in this new technological world. So that is something to keep in mind, but technology in general, yes, can be deflationary in nature, and that is something that Jim Grant also talked about in his report. So Vault, Caddy, the Fed do not cut rates next year. Market will reprice this quickly and violently. Says the market price in 5 cuts, right? Yes. So that is a big repricing risk the market carries right now, because it's already baked in 5 cuts at the moment. So if you come over to the Fed Watch tool, it's pretty clear that the Federal Reserve, obviously is penciled in 2, market's pricing in 5. So there's a big discrepancy, right? There is a massive discrepancy right now between what the market believes and what the Fed is telling us. It's like one of those memes I saw. The Federal Reserve keeps telling us no rate cuts, no rate cuts, no rate cuts, and market keeps believing more rate cuts, more rate cuts, more rate cuts. And that's just, it's a funny dynamic because markets rallying on the back of these rate cut expectations. And if they don't happen, that's the repricing risk that we have to deal with. Love Suit says, maybe surprise rate cut today. That would be crazy. If the Federal Reserve actually ends up cutting rates today, that would indeed be wild. It would be wild in a way that would be very unexpected. And of course, that would be very bullish for the market. The market will receive that really well. And I wouldn't be surprised if it does rally like 1% to 2%. But I don't think they're going to cut rates. Literally in their previous meeting in October, they said the rate cuts are not even in question right now. Inflation has not really come down in a dramatic fashion since then. So I think rate cuts are really out of question. They're not a possibility. So Mike, what is the one question you would ask Chairman Powell? Man, there's so many questions. There's honestly so many questions to be asked. But I know that Jerome Powell hates hypotheticals and he hates fiscal policy questions. So obviously I wouldn't ask him anything about fiscal policy, but I do want to ask him about a hypothetical. And that hypothetical is really all about inflation being higher while unemployment being higher as well. But I know the answer already. He's going to be like, you know what, we're not there yet. It's a hypothetical question, so I don't know what we're going to do. So I'm not going to get a straight answer out of him. I know that, but that would be a question that I definitely would like to ask and maybe get some insight into it. Because going into 2024, if we are in an environment where inflation still is above the Fed's target, which it is right now. So if you take a look at core inflation, it's at 4%, and unemployment still is pretty low. But if it starts to move back higher, then that's a problem, right? Because if you come back over to the dual mandate, right? And we've talked about this in our previous videos as well. By the way, the statement comes out in 3 minutes. In 3 minutes, folks, we will get the statement and the summary of economic projections in 3 minutes. So if you take a look at where we are in this bullseye, we are basically over here, all the way up here, because inflation's at 4%, unemployment is really low. So this is where we are. And the Federal Reserve's goal really is to bring this down to here, right? So this is what we're trying to accomplish. We're trying to go from this level where we are. So we're trying to go from here all the way down here. That's the Federal Reserve's goal. Now, my hypothetical question would be, and the Federal Reserve is really banking on this. They're really hoping that this indeed happens, right? That we actually do come down to this level. But my question would be, what if we're in an environment next year where instead of going down, we go sideways? We go in this top right quadrant where both inflation's elevated and unemployment starts going up, right? Hypothetically, Mr. Powell, if you were in charge of his... That is a question he is never going to answer, Kevin. Starting with hypothetically and fiscal policy, oh man, yeah, he's going to run to the other side. He's just going to be like, yep, this press conference is over. But yeah, so the point that I'm trying to make is they're really banking on the idea that by the time unemployment starts going up, inflation will be down. They're really banking on this, that by the time unemployment starts going, because interest rates this high for such a long time, it's actually surprising that the economy is not showing any signs of weakness. It's still resilient. It's quite surprising. But then it also makes sense because there's been a big transfer of wealth from the government sector over to private and households and businesses. You look at the government's balance sheet, it's horrible. It's horrible. The government is absolutely drowned in debt, with the Federal Reserve holding on to so many bonds that are underwater. So the government's balance sheet is terrible. But households and businesses and individuals, they're still doing well. They're still well capitalized to a point where there's still excess savings. Yes, people are now starting to dip into debt to kind of finance their lifestyle, but they're really banking. The Federal Reserve is really banking that by the time unemployment starts going up, inflation will hopefully be back down. But if it's not, and inflation stays up and unemployment starts to go up, that's a big problem. And that's what I'm really curious about, is what the Federal Reserve will then prioritize. Is it going to be fighting inflation, or is it going to be fighting unemployment or fighting recession? Anyway, so we've got numbers coming out in less than 5 seconds. Let's just go ahead and reload. Reload. Let's see what the numbers are going to look like. Here we go, folks. Here we go, everyone. As soon as these numbers come out, we are going to be live to look at them right now. Just reloading them again and again. Any second now, these numbers can come out. There we go. So there we have it. Opening up these two things. So interest rates, okay, no change in the interest rate expectations. Oh my God, the market's gonna rip, absolutely rip, because we have now seen rate cuts, significant rate cuts from 5.4 to 4.6. How many rate cuts is that? That's about 80 basis points. That's 3 rate cuts. 3 rate cuts is what the market, for Federal Reserve's penciling in. The market's going to rally on this news. This is actually good news for the market, because now the Federal Reserve's penciled in 3 rate cuts, which is more than the 2 they previously penciled in, and it's also coming down from a lower terminal rate. Earlier it was 5.6, and now they're looking for 5.4, and then bringing it down to 4.6, and originally there was 5.1. So they have now priced in 2 additional rate cuts going into 2024, which is actually great news for the market, which obviously is being received really well. Nasdaq's up 27 basis points, and we've got the S&P now rebounding back higher, up over 37 basis points as well. So this is actually good news for the market. because of two reasons. Number one, the market was correct. No hike in December, so we are steady. And of course, when it comes to the summary economic projections, 5.4% for this year, this is exactly where we are. And going into next year, 4.6%. Now, when it comes to unemployment rate, unchanged, absolutely unchanged. When it comes to inflation, 2.8% is what they're expecting for this year, 2.4 next year, 2.1 the year after. So just a slight decrease. And core inflation also expected to come down a little bit lower compared to their previous expectations. And GDP will continue to grow at a little bit over 1% on a nominal basis. But this is good news. This is good news because they are pricing in more rate cuts. 3 rate cuts are being priced in. So if you come back over to our this right here, I specifically mentioned, if you take a look at on this screenshot, I specifically mentioned here, this right here is neutral, right? So we already hit this. And when it comes to the guidance for 2024, what did we talk about? 3 rate cuts that would be unexpected and that would be bullish for the market. And this is exactly what we got from the Federal Reserve. That is 3 rate cuts, which is unexpected and bullish reaction from the market. That's what we're getting with the NASDAQ pushing higher. The yields dropping, man, they're just a little bit over 4% right now. So very, very strong move to the upside. And of course, look at the Dow. The Dow Jones is absolutely ripping right now, up over 176 points, up 0.5%. And got the NASDAQ up 43. And we've got the S&P 500 also up about 50 basis points to 46.66. This is what I'm talking about, folks. Absolutely incredible. If you take a look at big tech, so large cap, mostly turned positive and green. Netflix, Nvidia back up to 485. Apple's at 1.2, almost at a new all-time high. Is Apple at an all-time high right now? Almost. Apple's all-time high sits at 198.23. The market cap's at well over $3 trillion for Apple. Tesla's recovering a little bit, still down 1.5%. Vertex is having just a killer day. New all-time high at almost $400, 11.5% at the moment. So absolutely incredible move to the upside. So the numbers are out, and overall, pretty pleased with the overall cuts expectations here. TLT and TMF should be ripping. TMF is up over 4%. There we go, $59. Massive move to the upside for TMF. And TLT also moving higher, 1.3%, back up to almost $96, $97 over here. So congratulations for anyone who's been trading TLT or TMF. This is great news from the market. And of course, we're seeing a lot of momentum for a lot of individual stocks. More specifically, some of the more growth and more risk-on trades are certainly seeing a lot of momentum. IWM is up 82 basis points. Bitcoin is also charging higher, up over 2%. Volatility should be back down. There we go. It was up 3%. Now it's only up 17 basis points. And the dollar index right now is selling off as expected, down over 40 basis points, with crude oil seeing a little bit of that momentum back up, almost at $70 a barrel as well. So there you have it. There you have it. Significant cuts priced in. It is still less than the market. The market's pricing in for 5. The Federal Reserve's pricing in for 3, because 40 plus, actually, yeah, 40 plus 40, 80 basis points. 80 basis points is roughly 3 rate cuts, maybe 3 to 4 rate cuts, because every rate cut's 25 basis points. So 80 basis points is going to be roughly around 3 to 4 rate cuts is what the Federal Reserve's penciling in now. So we'll take a look at the meeting probabilities now moving forward and how this number's changed. But it'll take time for this to get readjusted after the numbers just came out. So we'll give it a few more minutes. But yeah, overall, very, very strong rate cuts expected from Federal Reserve. And there we go. NASDAQ here up 60 basis points. Look at those candles. Look at those candles. Absolutely incredible. And we got the Dow Jones also rallying, with the S&P also pushing higher. And again, this was expected. This is what we got. 3 rate cuts, bullish. And now it's time for us to listen to what Jerome Powell has to say in less than 25 minutes to kind of justify what is going to be the reasoning behind the rate cuts that they've penciled in now. If you come over to the dot plot, so let's just come down a little bit on the dot plot. And this has also changed pretty significantly. So all members, it's crazy. All of them expected, wow, it's all 17 members expected interest rates to be where they are. It was a unanimous vote. It's unanimous for keeping interest rates where they are. And then going into next year, most members expected interest rates to be lower. That's actually quite crazy that no one, not a single member, is expecting interest rates to be higher going into next year. It's all unanimous, and then going into next year and the following year, there's only one person. I don't know who it is. It's probably not Jerome Powell, but there's only one member that's expecting rates to be where they are going into 2025, except everyone else, majority of members are expecting rates to be lower, sub 4%. So that's the dot plot, and of course the summary of economic projections looks pretty good from the market standpoint, and hence the significant rally that we're seeing. So I just says, thank goodness I was down 500 on my Tesla calls. Very glad I didn't buy puts today. My gut was correct. Did Powell speak yet? Because my calls are starting printing. So Bundy, no. Powell will speak in about 23 minutes at 2:30 p.m. Eastern. Jerome Powell will come on live, and we'll listen to what he has to say. Look at the move on NVIDIA. Just incredible reversals for so many stocks here on the day right now. Tesla also recovering very nicely. We've got Apple recovering very well, up over 1% to 197. So big tech, of course, seeing a lot of momentum back higher at the moment. So, all right, so we're at 377 votes, people. We want to get to at least 500. So definitely do vote and participate in our poll. So all you have to do is just simply vote over here, whether you believe Jerome Powell today is going to be hawkish or dovish. 2/3 of you actually still believe that he's going to be hawkish. And definitely do share this live stream. All you have to do is just hit share and just copy this link or share it on WhatsApp or Facebook, Twitter, wherever. I would really appreciate that so that more and more people can join us on this interesting live stream. So Peter, in years past, when interest rates were at normal levels, how has the markets performed? So it really depends what you consider as normal levels, right? I mean, interest rates have even gone up as high as 18%, 20% in the 1970s and 80s during the Great Inflation. But interest rates over the last 20 years have mostly been muted, right? They haven't been as high as 4.5%, 5%. In fact, the treasuries, the bond market, so if you take a look at where the yields are, the bond market more specifically, we haven't seen yields as high as they are in over 16 years. So it's been over 16 years since the yields are as high as they are, and there's still not a lot of demand, right? That's what's the interesting part, is that there's still not a lot of demand for these yields. I mean, in any other environment, you'd be surprised. Like, capital allocators would be running over each other to grab these yields at over 5%, 5.4%. But right now, there's little to no demand. Maybe because there's expectations that interest rates are going to go higher on a yield basis, but clearly now I think there's a big shift that's happening, right? So if interest rates start getting cut, and that was the main thesis behind the TLT TMF trade in the first place, why else would I take a trade on TMF, right? It's because I'm expecting interest rates to go down next year. So that's why yields are now all of them down, right? So they're selling off, and I believe that it's going to continue as capital allocators like institution funds, endowments, sovereign funds, like all of them start to kind of feel that, okay, rates are not going higher now. They're not going to go higher anymore. It's time for us to lock in these rates for 10-year, 20-year, 30-year, 5-year, 7-year, whatever the maturity they want to pick. And that's when the demand comes in, prices go up, yields come down because of the inverse correlation. So this, very, very important. I think rates have peaked, at least in my opinion. We'll find out, of course, what happens next year, but for the most part, it does feel like it's peaked, and TLT and TMF definitely having significant rallies. 4% for TMF, back up to almost $60 at the moment. So next target for TLT really is going to be a breakout above $96, and then of course we're going to be watching the next resistance at about $101 per share for TLT. So that's where we are. Again, Jerome Powell is going to be talking in about 20 minutes. We'll listen in to what he has to say in a 45-minute conference. But let's just quickly break down some of the stocks for all of you. We'll do that for the next 15 minutes before we get ready for Jay Powell. So next 15 minutes, let me know if you have any questions about specific stocks. We can take a look at the fundamentals, the technicals. We'll go over that very, very quickly. And I can break those down for you. And again, even if you have any questions related to macroeconomics or inflation or recession or interest rates, I'm happy to answer those as well, or at least share my thoughts and share my perspective on those questions. So let me know if you have any questions related to either the macroeconomics, individual stocks, fundamentals, technicals, and I'm happy to go over those. Dow Jones almost kissing all-time highs. Yes, take a look at the Dow. We are almost at an all-time high. Absolutely incredible. This has been 7 green weeks in a row for the Dow Jones. The all-time high sits at well over 36,952. We just need to go up another 150 points, and we are at an all-time high for the Dow Jones. Is it a fake move? Ishwar is asking. I don't think so, because this was a very strong sort of SEP in favor of the bull market, in favor of a bullish move, because we talked about what the expectations were, and it all really came down to the guidance, right? This right here was really the thing that I was paying attention to. We talked about anything that's going to be over 2, 3 or more rate cuts for next year is going to be bullish, right? So we highlighted that over here in my previous videos. And what did we get? We got 3 cuts from the Federal Reserve, and then of course that's bullish. And as a result, the markets are obviously rallying quite a bit. Let's see. When investors wait till New Year for tax benefits before market pushing up next year. So yes, there could be some selling pressure going into January. December, once again, is one of the strongest months for the market in any given year. December is literally the strongest month from a seasonality standpoint. So with that in mind, it is very normal for us to see the short-term momentum higher on the back of course, a very nice pivot expected from the Federal Reserve. But going into January, I think you're correct. I think it's possible that there is some tax, there's some profit taking to kind of push out those tax liabilities into 2025. And for that reason, maybe there is a possibility for a technical pullback going into 2024, early 2024. So Lee, I do think that is possible. Okay, does all this info make you think to buy some stocks now? So I will continue to buy VUG, SMH that I've been buying. So VUG has had 7 green weeks in a row. It's up 62 basis points. This week it's up 1.4%. So, very happy and pleased to have been dollar cost averaging into this ETF. Been buying SMH as well. It's up 4% this week, up another 81 basis points today. So I've been buying VUG and SMH, been buying Realty Income Corp, which is up over 3% this week, up another 1.89% today. Happy to have picked it up in the mid 40s, and the stock's up already 22%. So these are some stocks that I'm picking up. I did a video on this. I picked up Enphase, I picked up Realty Income Corp, I picked up VUG, I picked up SMH. So these are companies. I picked up AMD. AMD started to position in the hundreds, and the stock's already up like 30%, or actually 44-45% from those levels. So these are stocks that I'm still going to continue to buy, but of course there's some analysis that needs to be done with respect to the technicals, fundamentals, and valuations. I'm not trading on the long side, so like for example QQQs right now very overextended, so I'm not like going to be taking a trade on TQQs. I actually did have a trade on TQQQ. I think I exited a little too early in the 40s, and from those levels it's rallied another 20-21%. So it's definitely done really well. It's up over 52%, 7 green weeks in a row. So that is something that I made money on, but I didn't make as much money as I could have had I held on to that position or that trade. But that's the market, right? You can't just get hung up on what you missed out on. You just got to keep moving forward and look for the next best opportunity. And sometimes we get too fixated on the fact that, oh, we made less, and we forget about the fact that we actually did make a profit. But we get too fixated on the idea that we made less profit. It is what it is, right? That's the market. There's always going to be something that you could have done, you should have done, you would have done. Just got to move past it and look for the next best opportunity. So for gold, yes, gold hit a new all-time high at over $2,000 an ounce. Starting to see a little bit of a pullback from that resistance. And right now we're kind of in this range-bound pattern where it's just continued to trade in this range, 1700 support, resistance a little bit over $2,000 as well. So gold is up as well. Strange. Do you believe the recession hard landing will still happen? So we haven't really seen a lot of evidence for it, right? Interest rates as high as they are, we haven't seen any weakness in the unemployment numbers. We haven't seen any weakness in the economic growth. We haven't seen anything that is suggesting for a super hard landing or a brutal recession. Maybe like a super moderate / mild recession is a possibility, but we haven't really seen anything from the economy that suggests that there could be a hard landing. So it's kind of hard to say. Yeah, Frank says the market does seem overextended to me. A lot of overpriced stocks out there. And that's really what we have to be cautious about. I know it's kind of hard to think about those things when the markets are rallying like they are right now. We've seen 7 green weeks in a row, and a lot of individual stocks are just absolutely straight up moving higher. So I know that it's kind of difficult to analyze the markets in an objective way to a point where the risk reward is not that favorable. We're overextended. There's a lot of overvaluation. There's a lot of frothiness in the market. And sometimes we just want to go with the flow. That's totally fine. But we also have to be aware of where we are. And the 2 words that I like to use is that I'm cautiously optimistic. Like I'm optimistic in the sense that markets are going to go higher. Absolutely. I think that, we're going to grow. And there's a lot of quality stocks out there. There's a lot of high quality businesses that are going to do well. But there's going to be cycles with that. There's going to be short-term cycles where we pull back, we push back higher, we pull back, we push back higher. So in that sense that we have to be cautiously optimistic. Okay, going over to PayPal. A lot of you folks asking about PayPal. So up a little bit over 2%. This week the stock's up over 2% as well. Seems to be validating that support at around $57. So that is going to be that level. And the next target and the resistance is going to be all the way up here at around $65 per share. So Conrad says, I think we're all traumatized from 2022. I think stocks are going on a sustained run, to be honest. Yes. So we're definitely pushing higher. The momentum is definitely in the favor of the upside, and the trend is your friend, right? So very, very strong move to the upside. So Peter, thanks for your fast, refreshing, and info on the rates. I made a 30% return just then. So I'm glad to hear that, and congratulations. And TMF is up 4% today. Yes. So that was, one of the main theses behind this trade was simply the idea that rates are not going to go up forever. Just like anything else, everything is mostly temporary in nature, right? So just like the markets, just like any stock, any index, any ETF, any commodity, any future, just like it's not going to go up on a straight line up, same exact thesis that rates are not going to go up forever. Eventually, the rates are going to get so attractive, right? If rates had gone up to over 8%, how many people in the chat would have completely ditched equities to have bought rates, to have bought fixed income? Let me know in the live chat. 1, if you would have done that. 2, if you would have avoided doing that. So type 1, if you would have completely ditched equities and stocks to buy bonds if rates were at over 8, 9, 10%. Let me know in the live chat. How many people would have done that? How many people would have just completely quit stocks and bought bonds if interest rates were at over 8, 9, 10%? I want to know in the live chat. 1, if you would have done that. 2, if you would not have done that. All right, so first one from Ty. If rates were at over 8, 9, 10%, right? So you were guaranteed to make 8, 9, 10%. You were guaranteed to make that much. Wow, some people would still not take that bet. That's crazy. It's risk-free and it's guaranteed 8, 9, 10%. How many people would have ditched equities and stocks to go after that fixed income? Any rational investor would go with the first option, right? A lot of people would type in 1. I would be the same way because you're getting a very, very significant return for little to no risk. So Conrad says equities would be so cheap at that point. I guess you've got a point there, because if interest rates are that high, the discount rates are really, really high, and equities relative to bonds definitely would be selling off to a point where they could be cheaper. But even then, I mean, 8, 9, 10% risk-free, guaranteed for 10 years, right? Imagine if a 10-year yield was at over 8%, 9%. Kevin says, I love risk. Of course you do. But see, there's a lot more ones, right? And that kind of makes the point that when interest rates go up as high as they did, the rates that we haven't seen in over 16, 18 years, that's what happens, right? There's a lot of demand that comes in, and eventually you'll see a lot of demand that comes in. There's some level of panic buying, and then rates drop and prices move back higher. And that's what happened with TMF and TLT. That's why we were so interested in that bond market trade. So Andy says market outperforming annually, not interested. I mean, you really think the markets would be able to outperform at over 10% over the next 10 years? I mean, the last 100 years, the S&P has only given us 7.5%, 8% on a nominal basis. So what makes us believe that the next 10 years, the market's going to give us anything more than that? That's the question, right? Because if you're able to get risk-free, see, the outperformance doesn't only come from a higher rate of return. The outperformance also comes from what? What else is really important element of outperformance? So if I put together two investors in front of you, the outperformance does not just come from a higher rate of return. What else does an outperformance come from? Let me see who can actually answer this question. Let me see. So outperformance in the market doesn't always come from a higher rate of return. Outperformance also comes from blank. What is that blank? Fill in the blank. Let's see. Yes, Revitage, got it. It's lower risk, right? So that's the thing, right? We often forget about the element of risk. So outperformance doesn't just always come from a higher rate of return. It also comes from generating a lower level of risk. So if an investor does not beat the S&P 500 but simply matches the S&P 500, right? So S&P 500, let's say that S&P 500 does an 8% rate of return. An investor makes 8% also. But that investor does that 8% with a lower level of risk compared to the S&P 500. Is that outperformance or not? Simple question. Simple question. If an investor matches the return of the S&P 500, but it does that with a lower level of risk, is that outperformance or not? Simple question. Yes, not losing money. That's absolutely right. Conrad, risk-adjusted returns. You're spot on. That's really what it comes down to, is risk-adjusted returns. By the way, we're gonna jump into the live stream here. So Mustafa says yes, and that is correct. Yes, that is outperformance. If an investor even matches the S&P 500, but they do that with a lower level of risk. Ooh, Win says no. Sohail says yes. Matt says yes. Yes, it is yes. That would be outperformance as well, because it's not always about the higher rate of return. It's also about the lower level of risk. And that's what Warren Buffett's been really good at. He's done that really, really well over the years, because some years you'll notice that he doesn't even beat the S&P 500. He's trailing the S&P some years. But it's the years when the S&P is down a lot is when he's actually losing less money. And that's what defensive investing is all about, right? You're very, very defensive in your approach, that you're losing less money, because recovery is much more difficult than generating higher returns. Recovering from your losses is far more difficult than actually generating more returns. So you need to avoid losing money in the first place so that you can actually have that outperformance over the long term. Frank says, Caddy, I live for alpha. That's great. That's awesome. Okay, so we are going to. So in today's world, I don't think anything that comes with 8% plus return would be risk-free. Yes, of course. I mean, I was just giving you a hypothetical that if interest rates are at over 8%, it was risk-free, would you take that after ditching equities? That was just a hypothetical question. Anyway, so we're going to jump back over to the press conference now. It's going to be starting very soon. There we go. I'm going to do an audio check as soon as he comes on board. And then I'll put that stream up here, like right over there. And of course, we'll put the markets right over here. So we'll have the NASDAQ, look at that, 14,600. S&P 500 over here. So Jose says, similar to running a mile in 350 with 14 miles per hour headwinds versus 350 with no wind. Correct. Yeah, I would say that's a fair comparison. That's a good analogy to go with. All right, so 3 minutes. 3 more minutes for the Federal Reserve, for Chairman Jerome Powell to come on board. I'm going to do an audio check. So just let me know if everything is working well, audio, video wise. And of course, we've got the NASDAQ over here, S&P over here. Guys, we are now 18 votes away from hitting 500 votes. Do me a favor, definitely participate in the poll. Vote what you think Jerome Powell is going to be, hawkish or dovish on the day today. 18 more votes to go. Definitely do participate so we can get a good data set. But majority of you, 64% of you, are expecting for Jerome Powell to be hawkish on the day today. So coming in very aggressive with his expectations. 17 more votes. Come on. We can do this. We can do this. We've got over 500 people watching. We can easily get up to over. There we go. 493, 97, and there we go. Perfect. Thank you so much. 500 votes. 63%. So 2/3 of you expect Jerome Powell to be hawkish, and 36% expecting for him to be dovish. So we'll find out in a couple minutes here. It's going to start in 2 minutes. 2 minutes, actually 1 minute now. I'll do an audio check, and we should be all set. I'll start taking some notes, and we should be good. We got the S&P over here, the NASDAQ up top, the S&P over here. We got the Magnificent Seven on the watch list, and of course Jerome Powell on screen. Out in a couple minutes here. It's going to start in 2 minutes. 2 minutes, actually 1 minute now. I'll do an audio check. Jerome Powell. All right. Should be good now in terms of the audio. All right, let's do this. This is it. Last meeting of the year, last FOMC meeting, and the last press conference of 2023. It's been a crazy year. The last couple of years have actually been very, very crazy. From the bear market of 2022 to an absolutely significant rally in 2023. It's been quite an interesting ride. So GK, everybody assuming markets to be overbought. Guess market ain't turning to this view changes. Yeah, so the markets can remain overbought for a really long time. So Ikadi, my bad if you've already been asked this. Okay, I'm gonna do an audio check. I'm gonna come back to all the questions after the press conference, but we're definitely gonna. This is important, so we'll listen to this, and then we'll come back to all the questions later. Definitely let me know in the live chat if the audio and the video is good. Just want to make sure that there's no technical difficulties, and just give me a thumbs up. Okay, give me a thumbs up in the live chat if the audio is good once he starts talking. It always happens, right? Markets rips, he starts talking, and the market tanks. Here we go. purple tie as always.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. As we approach the end of the year, it's natural to look back on the progress that has been made toward our dual mandate objectives. Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Chris Rugaber at Associated Press. I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
So specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Mr. Chairman, the microphone, sorry. Steve Leisman, CNBC. Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is, really how high to raise the policy rate, and that's really the question that we're still on here. We're very focused on that. As I mentioned, people generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's when you get to that question, and that's your answer. There's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this: we are seeing strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature, and we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Can you give some color as to the nature of that discussion today? Thank you.
Sure. So it comes up in this way today. Everybody wrote down an SEP forecast, so many people mentioned what their rate forecast was, and there was no back and forth, no attempt to sort of reach agreement, like this is what I wrote down, this is what I think, that kind of thing, and a preliminary kind of a discussion like that. Not everybody did that, but many people did, and I would say there's a general expectation that this will be a topic for us looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Go to Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that. I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The question is it? So it's a possibility here. I have always felt since the beginning that there was a possibility because of the unusual situation that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that the economy will behave in an unexpected way. It has done that repeatedly through in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
I'm curious if you're looking back on the past year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession for this year, for 2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters. A very high proportion of forecasters were expecting very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, the shortages and the bottlenecks really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus or a little more than that growth year at a time when potential growth this year might even have been higher than that just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. That didn't really happen. We're still at 3.7%. So we've seen, strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year, whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices, in the price level that you're expecting, in the rate of inflation that you're expecting, as opposed to supporting the economy?
Nothing quite that mechanical is happening. The SEP really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy. And I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down basically each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor. And it's certainly a big part of, it's a part of how we think about things, but really it's broader financial conditions that matter. And as you well know, it's so hard to know exactly, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time. But it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over that, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election. Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over that assessment, really, over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was 60, 90 days ago. So that's how we're approaching things. And as I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to, start to dial back on the tight policy we have in place. And that's a discussion we'll be having going forward, but that's another assessment that we're going to make very carefully. So as time goes forward.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level with cuts beginning around March. Is this something that you are broadly comfortable with?
So this last year has been remarkable for the sort of seesaw thing back and forth we've had over the course of the year of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals. And that's what we really focus on. And people are going to have different forecasts about the economy. And those are going to show up in market conditions or they won't, but in any case, we have to do what we think is right. And, in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth, and I'm just focused on what's the right thing for us to do, and my colleagues are focused on that too.
The markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So it's our job to restore price stability, and that it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Gina Smilik, New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress on inflation alone be sufficient?
So we'll look at the totality of the data. Growth is one thing. So is inflation, so is labor market data. So we'd look at the total, as we make decisions about policy changes going forward, we're looking at all those things, and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%. But if we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably will keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again. it just is, it's the way our policy works.
Go to Neil.
Hi, Chair Powell. Neil Irwin with Axios. How do you interpret the state of the labor market right now? And in particular, you've referred even today to evidence that it's coming into better balance. What would you need to see to conclude that it has reached that balance?
So on the better balance side, there's just a lot of things. It's you see job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation. The things that are not quite, but let me go on with that list. Claims are low. If you look at surveys of businesses, they're sort of the era of this frantic labor shortage are behind us, and they're seeing a shortage of labor as being significantly alleviated. If you look at shortages of workers, whereas they thought job availability was the highest it had ever been or close to it, that's now down to more normal levels by so many measures: participation, unemployment, so many measures, the unemployment, job openings, quits, all of those things. So wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say. And I guess there are just a couple of other, the unemployment rate is very, very low. And these are, but I would just say overall, the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases.
Claire.
Jones, Financial Times. I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now, real wages are now positive, so that wages are now moving up more than inflation as inflation comes down. And so that might help improve the mood of people. But we see those public opinion surveys. The thing that we can do is to do our jobs, which is to use our tools to foster price stability, which has such great benefits over such long periods of time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is so beneficial for families and companies around the country.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, on the flip side of if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise at sort of the levels of inflation that we're seeing now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Sorry, if
the economy looks like it's starting to fall into recession, if the jobless rate starts to rise?
That's not something we're hoping to see. Obviously, we're hoping to see something very different, which is continuation of what we have seen, which is the labor market coming into better balance without a significant increase in unemployment, inflation coming down without a significant increase in unemployment, and growth moderating without a significant increase in unemployment. That's what we're trying very much to achieve, and not something we're looking to see.
But would you take that as a signal that you should cut rates?
Obviously, what we'll do is we'll look at the totality of the data, as I've mentioned a couple of times, and certainly the labor data would be important in that. And if you can describe a situation like that where if there were the beginning of a recession or something like that, then yes, that would certainly weigh heavily in that decision.
Michael McKee from Bloomberg Television and Radio. Mr. Chairman, you were, by your own admission, behind the curve in starting to raise rates to fight inflation. And you said earlier, again, the full effects of our tightening cycle have not yet been felt. How will you decide when to cut rates, and how will you ensure you're not behind the curve there?
So we're aware of the risk that we would hang on too long. You know, we know that that's a risk, and we're very focused on not making that mistake. And we do regard the two, you know, we've come back into a better balance between the risk of overdoing it and the risk of underdoing it. Not only that, we were able to focus hard on the price stability mandate, and we're getting back to the point where, which is what you do when you're very far from one of the two mandates. You're getting now back to the point where both mandates are important, and they're more in balance too. So I think we'll be very much keeping that in mind as we make policy going forward. And the things we'll be looking at, I've already described. You know, we're obviously looking hard at what's happening with demand, and what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good reason to believe that growth will come in lower next year. And you see what the forecasts are. I think the median participant wrote down 1.4% growth, but you know, we'll have to see. It's very hard to predict. We'll also be looking to see progress on inflation and you know, the labor market remaining strong, but ideally without seeing the kind of large increase in unemployment that happens sometimes.
When you begin the cutting cycle, will it be essentially run the same way you do it now with raising rates, where you basically do trial and error, cut and see what happens, or will you tie it to some particular measure of progress?
We haven't typically tried to articulate, with one exception, a really specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013. The answer is, these are things that we haven't, you know, really worked out yet. We're sort of just at the beginning of that discussion.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So if the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal or that there's a belief of weakness next year in the economy?
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something, you know this, but allow me to say it again. We don't debate or discuss what the right, you know, whose SEP is right. We just say what they are and we tabulate them and publish them. So it's, you know, it's important for people to know that, but it wouldn't need to be a sign of, it could just be a sign that the economy is normalizing and it doesn't need the tight policy. It depends on, the economy can evolve in many different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
Well, that's what we're finding out, and we've seen real progress in core inflation. It has been sticky, and famously, the service sector is thought to be stickier. But we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing at different levels, you know, meeting by meeting, or rather report by report. So, yeah.
Okay, let's go to Katerina.
Katerina Saraiva, Bloomberg News. Thanks for taking our questions. I just wanted to ask a little bit about, you know, we had some pretty positive data this morning and yesterday. I'm assuming those were not incorporated into the forecasts we see today. But I just wanted to ask, you know, how that kind of adds to your thinking, you know, on the inflation outlook.
Right. So we got CPI the morning of the first day, and we got PPI the next day, which informs the, you know, the translation into PCE. So it's very, very late in the game, you know, but nonetheless, participants are allowed to, encouraged to update their SEP forecasts until probably mid-morning today. After that, so staff has to accumulate all of that and create the documents that you see. So until about mid-morning, a little, maybe late morning, it's okay to update. And I believe some people did update their forecasts based on what we saw today.
Do you see, I mean, how are you, when you think about, starting to think about the rate cuts next year or whenever they come, how do you think about the economy we're in now, kind of post-pandemic? Do you think that there's been significant structural shifts, and is that going to change how you look at a rate cut path?
The question of whether there have been fundamental structural shifts is a really hard to know the answer, and a very interesting one right now. The one that would affect, one that comes to mind, though, is just the question of where the neutral rate of interest is. And so, for example, if it's risen, and I'm not saying that it has, but if it were to have risen, that would mean that interest rates would need to be a little bit higher to convey the same level of restriction. The thing is, we're not really going to know that. People will be writing papers about that 10 years from now and still fighting about it. So it's just that it's going to be uncertain. So we're going to be making policy in this difficult, uncertain, really unprecedented environment. Someone once said that the natural rate of interest by its works, and that's really right. But that's very difficult because policy operates with a lag. So it's one of the reasons why we slowed down this year. We started slowing down at this meeting last year, reducing the pace at which we were adding restriction. And over the course of this year, we really slowed down a lot to give those lags time to work. In terms of demand, has demand shifted more away from services into goods? You can make a case for that the shift back into services has not been complete, and it doesn't look like it's ongoing, but I don't know if that's right. Maybe people just bought so much stuff that they temporarily don't want any more stuff. They haven't got any place to put it.
Go to Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said back in July that you needed to start cutting rates before getting to 2% inflation. As you mentioned, PCE inflation is now running at 3.5% on core. On a 6-month annual basis, core PCE is running at 2.5%. Though when you look at super core and shelter, they are of course stickier. So in looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be too late. I mean, you'd want to be reducing restriction on the economy well before 2%, because before you get to 2%, so you don't overshoot. If we think of restrictive policy as weighing on economic activity, it takes a while for policy to get into the economy, affect economic activity, and affect inflation. So I can't give you a precise answer, but if you look at what's in the SEP, and I think you'll see a reasonable estimate of the time lags and things like that it would take.
Do you think below 3% would be reasonable?
I wouldn't want to identify any one precise point, because I would be able to look back then and probably find out that it turned out not to be right. But we'll be looking at it and looking at the broad collection of factors.
Hi, Chair Powell, Jean Young with Market News. Wanted to go back to the stickiness of inflation question. Over the past couple of years, a lot of central bankers have talked about the more difficult last mile of getting inflation back down to 2%. Yet it's also been surprising how fast inflation has come down this year. I'm curious, do you think something has changed in our understanding of inflation? Or do you subscribe to this notion still, or is it something different about the U.S. economy?
I think this, we felt since the beginning that it would be a combination of two factors. The first factor is just the unwinding of what happened in the pandemic, the distortions of supply and demand. And the second thing would be our policy, which was weighing on aggregate demand and actually making it easier for the supply side to recover because of lower demand. We thought those two things were going to be necessary. Sorry, say the last part of your question again.
If if there was something different about the U.S. economy.
Yeah, so it's not that, it may or may not be about the U.S. economy being different. I think that this inflation was not the classic demand overload, pot boiling over kind of inflation that we think about. It was a combination of very strong demand, without question, and unusual supply side restrictions, both on the goods side but also on the labor side, because we had a participation shock. So this is just very unusual. And, you know, we had the view, my colleagues and I broadly had the view that we could get a lot of, you know, you had essentially a vertical supply curve, because you ran into the limits of capacity at very low levels because there weren't workers and because people couldn't, the supply chains were all broken. So we had the view that you could come straight down that vertical supply curve to the extent demand reduced. And, you know, something like that has happened. It happened so far. The question is, you know, once that part of it runs out, and we think it has a ways to run, we definitely think that the sort of supply chain and shortages side has some ways to run. Does labor force participation have much more to run? It might. Immigration could help, but it may be that at some point you will run out of supply side help, and then it gets down to demand and it gets harder. That's very possible. But to say with certainty that the last mile is going to be different, I'd be reluctant to, you know, to suggest that we have any certainty around that. We just don't know. I mean, inflation keeps coming down, the labor market keeps getting back into balance, and you know, it's so far so good. Although we kind of assume that it will get harder from here, but so far it hasn't.
Okay, we'll go to Megan for the last question.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I want to ask about the balance sheet, given the Fed's focus now on proceeding carefully and considering rate cuts. And can you talk us through what the latest thinking is, and has there been any consideration of altering the pace of quantitative tightening at all?
We're not talking about altering the pace of QT right now, just to get that out of the way. So balance sheet seems to be working pretty much as expected. What we've been seeing is, you know, that we're allowing runoff each month. That's adding up. I think we're close to 1.2 trillion now. That's showing up. The reverse repo facility has been coming down quickly, and reserves have been either moving up or as a result or holding steady. At a certain point, you know, there won't be any more to come out of, or there'll be a level where the reverse repo facility levels out. And at that point, reserves will start to come down. We still have, you know that we intend to reduce our securities holders until we judge that the quantity of reserve balances has reached a level somewhat above that consistent with ample reserves. And we also intend to slow and then stop the decline in size of the balance sheet when reserve balances are somewhat above the level judged to be consistent with ample reserves. We're not at those levels. With reserves close to $3.5 trillion. We don't think we're at those reserves. There isn't a lot of evidence of that. We're watching it carefully, and so far it's working pretty much as expected, we think.
Adjusting that thinking at all by the time you're considering or moving forward with rate cuts? Is that time to rethink, or are you still going to follow that thinking?
So I think they're on independent tracks. So you're asking, though, the question, I guess you're implying the question of can you continue with QT at such time, QT, which is a tightening action, at such time as policy is still tight? And the answer is it depends on the reason. You know, if you're cutting rates because you're going back to normal, that's one thing. If you're cutting them because the economy is really weak, so you can imagine you have to know what the reason is to know whether it would be appropriate to do those two things at the same time.
Thank you.
Thanks very much.
All right, everyone. So that was incredibly bullish. I mean, lots of talk around rate cuts, recession expectations, obviously not expecting a recession, at least not yet. And of course, going into next year, we talked about how the Federal Reserve is really banking on the idea that unemployment is not going to be higher, at least not before inflation comes back down, because those two things cannot happen simultaneously. The market's absolutely ripping. Nasdaq's up a little bit over 1%. We've got a new all-time high on the Dow Jones. So if you take a look at the Dow Jones here, DJI, 37,000 on the Dow Jones, fresh all-time high for the Dow. So 1% higher on the day. Congratulations, folks, for everybody. S&P 500 is also almost at an all-time high. It is at just under 4,700, and it is only less than 3% away from an all-time high at the moment. So I'm going to break down everything in a separate video. It is almost 2 in the morning here in India, and I am absolutely exhausted. So again, thank you so much for joining for this longer live stream. I really appreciate each and every one of you. Make sure that you drop a like and subscribe to the channel. Market updates going to be coming out later today, and I will be doing a video summarizing everything Jerome Powell mentioned and talked about in the press conference. So it's going to be a nice summary video of less than 10 minutes to go over everything important Jerome Powell talked about. So thank you so much again for joining. Make sure that you drop a like and definitely subscribe to the channel if you haven't already. Links to our Discord and Patreon is going to be down below. You can access all the members-only videos if you do join, and of course Excel spreadsheets with our intrinsic values, our fair value calculators, volatility spreadsheets, S&P 500, everything's going to be included. And more importantly, of course, the Discord is also going to be available with over 20 plus channels that you can access with trade alerts and trade ideas. Everything's going to be available over there as well. So link's going to be down below. I'm also going to pin the link in the comments. So definitely do check that out as well. And that's going to be it for today. And of course, a very, very bullish reaction from the market with an all-time high from the Dow. S&P less than 3% away from an all-time high. And the Nasdaq, I think, is less than 6 or 7% away from an all-time high as well. So it's definitely been pushing higher, of course, 7 straight green weeks in a row. Just over 10%. It needs to move higher to get to an all-time high. Individual stocks, very, very quick update. AMD here, up over 38 basis points. We're not seeing a lot of momentum, but definitely Magnificent Sevens are still up. Netflix kind of leading the charge, up 3.5%, along with Apple up 1.24%. Amazon up close to 1%. We got Tesla, Google, Meta, AMD, everything green. Microsoft slightly down, 39 to 40 basis points, and volatility absolutely getting crushed once again in the low 12s, up just about 50 basis points as well. The Indian markets have been doing really well as well. We talked about INDA. Look at that, at an all-time high. INDA was one of my Indian picks. We talked about this back in February and March. And of course, since then it has rallied over 21%. I will be doing an update on my Indian portfolio as well for members only. We'll be talking about that in a private video. So again, if you want to get access to all the members only videos, link's going to be down below. So thank you so much for joining, everyone. Hope you all have a fantastic day. I will be posting a lot of these updates and videos later today. So thank you so much for joining. As always, happy investing. We'll see you all in the next